What if the safest part of your portfolio is actually the biggest ticking time bomb? For decades, people nearing retirement were told the same thing. Stocks are risky, but bonds are safe. That's why so many investors, especially those in their 60s and 70s, have loaded up on bond funds, thinking they were buying peace of mind. But that belief, once reliable, is about to be tested in a way most people aren't ready for. Because something is quietly building beneath the surface of the bond market. And when the next interest rate spike hits, projected as early as 2026, it won't just shake risky assets. It could bring down the very funds people thought were untouchable. See, most investors don't realize that bond funds aren't like holding an individual bond to maturity. When rates rise, these funds can bleed value fast. And while everyone's watching the stock market, few are paying attention to the quiet cracks forming in their so-called safe money. In this video, we're going to expose the hidden risks inside bond funds that most financial advisors won't talk about. You'll learn why the next rate hike could be far more damaging than expected, how traditional bond strategies are becoming outdated, and what smart investors are quietly doing to avoid what's coming. If you're retired, planning for it, or just someone who values stability in your portfolio, this isn't something you can afford to ignore. Because by the time the headlines catch up, it might already be too late. Most people don't question the idea that bond funds are safe. They've been marketed that way for decades, stable, conservative, reliable. But that sense of safety is exactly what makes them dangerous right now. Because underneath that calm exterior is a hidden risk most investors never notice until it's too late. Here's the part no one tells you. Bond funds are not the same as individual bonds. When you buy a single bond, you lock in a fixed return and know exactly when you'll get your money back. But with a bond fund, you're in a constantly shifting pool of bonds being bought and sold based on market conditions. There's no maturity date, no guarantee, and no control over how long your money stays exposed. This becomes a serious problem when interest rates start to rise. As new bonds enter the market offering higher yields, the older bonds in your fund, those with lower payouts, start to look less attractive. That drives down their value, and your fund takes the hit. Investors expecting stability suddenly see their safe investment bleeding red. And the worst part? Many people don't even realize it's happening. They open their statements, see a modest decline, and assume it's temporary. But when rates keep climbing as they're projected to through 2026, that decline can compound fast. We're not talking about minor fluctuations here. We're talking about real erosion of wealth in accounts that were supposed to be protected. It's a quiet kind of loss. There's no crash, no panic, no dramatic headlines. Just a slow, steady leak that drains the value of your investments while everyone tells you to sit tight. But for people in retirement or approaching it, that kind of erosion isn't just inconvenient. It's devastating. And this isn't just theory. It's already happened before. In past rate hiking cycles, long-duration bond funds have dropped 10%, 15%, even 20% in value. But few people remember that because bonds aren't flashy. They don't make the news when they fall apart. But the conditions are forming again. And this time, the fallout could be worse. The real danger hiding inside bond funds isn't just the bonds themselves. It's something called duration. And if you've never heard of it, you're not alone. Most everyday investors have no idea how powerful this one word can be when interest rates start to rise. Duration is a measure of how sensitive a bond fund is to changes in interest rates. The higher the duration, the more damage a rate hike can do. For example, if your bond fund has a duration of 10 and interest rates go up by just 1%, your fund could lose roughly 10% of its value. And if rates climb by 2% or more, which is entirely possible by 2026, those losses double. Quietly, brutally, without warning. Now here's the part that really stings. Many so-called safe bond funds have high durations, especially long-term government and corporate bond funds. These are the same funds financial advisors often suggest to people approaching retirement, people who can't afford to take big hits. But they're exactly the ones most vulnerable when interest rates start climbing fast. It's not that the bonds themselves are bad, it's that the timing is. Because if you're holding a fund filled with low-yield, long-duration bonds while the Fed is hiking rates, you're sitting on a shrinking asset. You're earning a modest yield while the actual value of your investment quietly drops day after day. Worse still, most investors don't realize this is happening until they've already lost money. They think bonds are slow and steady and don't check the fine print. They don't look at the fund's duration or understand how exposed they really are. And when the next rate spike hits, and it's coming, it won't matter how safe your portfolio felt. The math doesn't care about your age or your risk tolerance. This isn't a market dip you can ride out. Duration-based losses don't bounce back overnight. It can take years for a long-duration bond fund to recover from a rate hike cycle. And if you're living off those funds in retirement, you might not have years to wait. That's why understanding duration isn't optional anymore. It's essential, because once rates start climbing, and they will, the bond funds with high duration won't just dip. They'll slide, and they may not stop until the damage is done. Most people think they'll see a rate hike coming. They assume the signs will be obvious, the warning's loud, and the market's prepared. But what's building behind the scenes doesn't look like the typical economic cycle. The 2026 rate hike isn't expected to be just another blip. It could be a shockwave. And very few people are actually ready for it. Right now, the Federal Reserve is walking a tightrope. Inflation cooled off in 2023, but in 2024 and early 2025, signs started creeping back in. Rising energy prices, tight housing supply, wage growth that refuses to slow down. On the surface, things seem stable. But buried deep in meeting transcripts and policy statements is a consistent pattern. They're not done raising rates. They're just waiting. That's the dangerous part. Because once inflation kicks up again, and many analysts believe it's already smoldering, the Fed may be forced to act quickly. We're not talking about gradual, well-telegraphed hikes. We're talking about a rapid-fire tightening cycle that could begin as early as Q1 of 2026. And when that happens, bond funds that are stuffed with low-yield debt from the last few years will be caught completely off guard. Why? Because bond funds aren't built to pivot. They're loaded with fixed-rate assets that instantly lose value when rates jump. And the older the bonds, the harder they get hit. Managers can't just dump everything and start fresh. They're locked in, which means you're locked in, too. This is where the illusion of safety really falls apart. Investors think their bond funds are protected because they've been calm for years. But that calm has been artificial, propped up by historically low rates and central bank support. That support is fading. And when it disappears, what's left behind could be a market that moves faster than anyone expects. What makes this even more dangerous is the complacency. Most investors aren't watching the bond market. They're watching stocks, crypto, housing. Meanwhile, the next major hit to their portfolio could come from the most boring part of it, the bonds. Quiet, invisible, and devastating. And once the rate hikes begin, it's too late to reposition. The damage will already be happening, which is why waiting to make changes could be the most expensive mistake investors make in this entire cycle. Most investors assume they can get out whenever they want. That's the promise of bond funds, right? Daily liquidity, easy access, no drama. But what they don't realize is that this promise is only good when everything is calm. When panic hits, that liquidity vanishes, and it happens faster than you'd think. Here's what really goes on behind the scenes. Bond funds operate under the assumption that only a small number of investors will redeem shares at any given time. That works in normal conditions. But when interest rates spike or the market gets spooked, redemptions surge. People rush to pull their money out. And that's when the problems begin. Fund managers have to sell bonds to meet those redemption requests. But in a stressed market, those bonds aren't worth what they were yesterday. Buyers disappear, prices drop, and managers are forced to unload assets at a loss just to return cash to panicked investors. And that loss? It doesn't just hurt the people who leave, it hits everyone still in the fund. This is known as a liquidity crunch, and it turns your supposedly safe bond fund into a slow-moving wreck. Even if you didn't panic, you're stuck absorbing the damage caused by others who did. It's like being on a boat where people start jumping off, and every time someone leaves, the whole thing sinks a little lower. It happened in 2020 when markets froze up and bond funds were pushed to the brink. The only reason they didn't collapse was because the Fed stepped in with emergency measures. But that kind of bailout isn't guaranteed next time. And if inflation is still hot in 2026, the Fed may not be in the mood to save the bond market again. And let's be clear, this doesn't just affect exotic or high-risk funds. Even mainstream bond ETFs, which are marketed as ultra-liquid, can face major price dislocations when the underlying assets become hard to trade. The price you see on your screen may not reflect the actual value of what's inside the fund. And in a sell-off, that gap can widen fast. So while you might think you can just pull your money out if things get bad, the truth is you may be exiting into a falling market, locking in steep losses. Liquidity only matters when you need it, and in a real interest rate shock, it might not be there at all. Right now, bond funds are luring investors in with one thing: yield. After years of ultra-low interest rates, people are desperate for income. So, when they see bond funds advertising 5%, 6%, or even higher returns, it's easy to get tempted, especially if you're retired or relying on fixed income. But that yield, it's not free, and in many cases, it's hiding a dangerous level of risk. The truth is, high-yield bond funds are often filled with what the industry politely calls non-investment grade debt. In plain terms, junk bonds. These are loans made to companies with shaky credit, uncertain cash flow, and a much higher chance of default. In good times, they pay handsomely. But in tough times, like after a rate spike, they're the first to collapse. And here's where it gets even more concerning. When interest rates rise, those risky companies suddenly have to refinance their debt at much higher costs. Some can't. They default. And when enough of them default, the fund starts to bleed from the inside. That 6% yield quickly turns into a negative return, and worse, a permanent loss of capital. But most investors don't see that coming. They just see the income, the monthly payouts, the reassuring marketing language about diversification and income strategy. They don't dig into what's actually inside the fund. They don't realize they're lending to companies that may not survive the next economic shock. And it's not just junk bonds. Even some investment-grade funds are packed with corporate debt from companies that stretched themselves thin during the low-rate era. Those same companies now face refinancing pressure as their old debt matures and the cost of borrowing doubles or triples. That pressure gets passed straight down to investors. So, if you're chasing yield right now, thinking you've found a safe, income-generating alternative to stocks, you might be sitting on a portfolio of ticking time bombs. Because once defaults start to rise, they don't stay isolated. They ripple through the entire high-yield market, dragging down prices and confidence all at once. And by the time the headlines catch up, it's already too late. The fund has already dropped. Your capital is already damaged. That safe 6% turns into a lesson you can't afford to repeat. There's a common belief that index funds are the safest way to invest. Set it, forget it, and let the diversification do the work. And for stock investors, that approach has worked well over the years. But when it comes to bond index funds, that same blind trust can quietly become a major liability. Because most investors don't realize just how exposed these funds really are. Bond indexes aren't actively managed. They don't shift to safer assets when risk rises. Instead, they follow a strict formula, tracking a market-weighted basket of bonds based on outstanding debt. And that's where the trap begins. The bigger the debt, the bigger the weight in the index. So, the companies and governments with the most debt get the biggest representation. Think about that for a second. If a corporation issues more debt, it gets a larger slice of the fund. Not because it's safer, not because it's better, just because it owes more money. The same goes for treasuries. U.S. government debt has ballooned in recent years, which means many index bond funds are now stuffed with long-duration, low-yield bonds that are highly sensitive to rate hikes. So when interest rates start climbing, those bond indexes get hit hard. They can't pivot. They can't move into short-term debt or reduce risk exposure. They just track the index even as it sinks. And investors who think they're being conservative by sticking with a broad bond ETF could be exposing themselves to losses they never saw coming. Even worse, most people don't read the fine print. They don't know how much of their index fund is locked into long-duration government bonds or over-leveraged corporate debt. They just see a familiar name, a solid-sounding yield, and assume they're playing it safe. But what they're really doing is handing over control to a formula that doesn't care what the market is doing. In a rising rate environment, that kind of passive exposure can be dangerous because bond prices fall as rates rise. And when you're holding a basket of long-term debt that can't adjust, the decline can be sharp and painful. You're not diversified across risk, you're concentrated in it. And while individual investors are holding tight, thinking the fund will bounce back, eventually, they may not realize that some of the bonds inside will never recover. They'll mature at lower yields, get rolled over into new, higher-rate debt. But that doesn't help the price of the fund you're already in. So, if you think your index bond fund is a safe haven, it's time to look closer. Because the math behind it doesn't care about your retirement plan. It only cares about the weight of debt. And in a world where rates are climbing and debt is exploding, that formula could quietly drag your portfolio down faster than you think. So, what are the smart investors doing right now? The ones who see what's coming and aren't willing to sit back and watch their safe money get wiped out? They're not chasing yield. They're not trusting passive strategies. And they're definitely not assuming that what worked for the last 10 years will keep working through 2026. Instead, they're getting selective. They're moving into short-duration bonds, those that mature in 1 to 3 years, because shorter-term debt is far less sensitive to interest rate hikes. The idea is simple. The quicker the bond matures, the faster you can reinvest at higher rates without suffering big losses along the way. They're also looking at treasury bills and other ultra-short-term government securities, which now offer competitive yields without the same exposure to duration risk. These are tools that used to be overlooked when rates were near zero, but now they're back in play. For conservative investors, they offer something rare in today's market: safety that actually behaves like safety. Others are shifting into laddered bond portfolios, where bonds mature at staggered intervals. This strategy smooths out the impact of rising rates by constantly rotating into newer, higher-yielding debt. It's not flashy, but it's resilient. And in an uncertain environment, that's exactly what matters. Some are even exploring floating-rate instruments, bonds or notes, that adjust their interest payments based on current rates. When rates rise, so does your income. It's not a perfect hedge, but it's a strategic way to stay flexible while others get crushed by fixed-rate exposure. And then there are those taking a more defensive stance altogether, holding more cash or cash equivalents, even if it means earning slightly less in the short term. They know that preserving capital matters more than squeezing out an extra percent of yield. Because what good is a 6% return if your fund drops 15% when rates spike? The point is, they're not passive. They're proactive. They've stopped assuming that bond funds will always be the low-risk, high-confidence part of the portfolio. Instead, they're asking the hard question: what happens if the next rate hike isn't mild but massive? And while others are distracted by the stock market or lulled into comfort by past performance, these investors are building portfolios that can bend with the pressure, not break under it. Because when 2026 hits and the interest rate shock unfolds, the ones who stay flexible will be the ones still standing. For decades, bonds have been the quiet, dependable backbone of a conservative portfolio. They were the fallback plan, the safe zone when markets got rough. But that comfort is fading, slowly and then all at once. What we've uncovered in this video isn't speculation. It's a hard look at what happens when an old strategy meets a new reality. rising interest rates, long-duration exposure, hidden risks inside bond funds, and a passive system that no longer protects you the way it used to. The idea that bonds are always safe is being tested, and for many investors, that test could come with a steep price. So, ask yourself, are you holding on to outdated assumptions about what's low risk? Is your portfolio built for a market that no longer exists? Because the rate hikes on the horizon aren't just numbers, they're signals. And if you're not watching them closely, they could quietly erode the very money you thought was protected. The truth is, most people won't act. They'll wait, they'll hope, they'll trust that what worked yesterday will work tomorrow. But the few who take a closer look, who ask the uncomfortable questions and make the hard adjustments, those are the investors who'll come out stronger. So, before 2026 arrives, take a good, honest look at what's really in your safe bucket. Because once the shock hits, it won't be the riskiest assets that surprise you. It'll be the ones you thought you didn't need to worry about.